You want to invest, but should you pick cash payout dividend stocks or bet on explosive growth? Only one truly builds long-term wealth. Let's settle it right now. Let's cut through the noise. A dividend stock is a company, usually a stable giant like Coca-Cola or Verizon, that pays you a piece of its profits just for owning their stock. These are mature, blue-chip businesses. They've already conquered their markets. They're not trying to be the next big thing. They are the big thing, and they reward you with it for a check. Think of it like getting a regular paycheck from your investment. A growth stock is the opposite. Think Tesla or Amazon in their prime growth phases. These companies are in disruptor mode. They take every penny of profit and plow it right back into the business to expand like crazy, funding new research, entering new markets, hiring top talent. They're sacrificing today's profit for tomorrow's market domination. No payouts for you now, but the goal is for the stock's value to skyrocket later. So here's the simple breakdown. Dividends are slow and steady checks landing in your account. Growth is a fast but much more volatile rocket ride. Okay, so how does the money actually work? With dividends, you get cash flow now. You get a paycheck every quarter, even if the stock price doesn't move an inch. It's a tangible, reliable return. With growth stocks, you're playing for capital gains later. Your money grows inside the stock as the company's value increases, but you only see that cash when you decide to sell. Let's run some real-world math. Put $10,000 into a solid stock with a 5% dividend yield. That's $500 in your pocket every single year. You can use it to pay a cell phone bill or, better yet, reinvest it. That buys you more shares, which then pay you more dividends next quarter. It's a slow but incredibly powerful snowball of wealth. Now put that same $10,000 into a portfolio of growth stocks, averaging a 12% annual return. After just 3 years of compounding, your initial investment is worth over $14,000. That's a $4,000 gain, but it's all on paper until you sell. The company is using your money to innovate and expand, and the market is rewarding that by bidding up its price. And don't forget taxes. This is a huge deal. Dividends are taxed every single year you receive them. It's an annual drag on your returns, like a small constant leak in your bucket. With growth stocks, you pay zero tax until the day you sell. That tax deferral is a massive advantage. The bucket stays sealed, letting every single drop of your money compound for years or even decades. Now let's talk about the trap that snares so many investors. Most people hear passive income and blindly chase dividend stocks. They fixate on the yield but completely ignore the price chart. What good is a $500 dividend check if the stock itself loses $1,000 in value? That's a net loss of $500. That's called a yield trap. People chase an 8% yield from a company whose stock has been falling for 2 years straight. They're picking up pennies in front of a steamroller. Inflation is another silent killer here. If your dividend isn't growing faster than inflation, you're actually losing purchasing power every year. On the flip side, the trap with growth stocks is pure human psychology. The price shoots up and everyone feels like a genius, but when it inevitably has a bad quarter and dips 30%, panic sets in. The fear of losing everything makes people sell at the bottom, locking in huge losses, often just before the stock starts to climb again. They get whipsawed, buying high and selling low, the exact opposite of the entire game. The wrong strategy at the wrong time means wasted years and lost money. If you're tired of guessing with your money and want this stuff broken down in plain English, subscribe now. We do this every week. So which is for you? This isn't a trick question. Choose dividend stocks if you want income now. Maybe you're nearing retirement, or you just want a predictable cash flow to cover some bills. They're also for you if you value stability and want to sleep better at night during stock moves. The secret weapon here is reinvesting those dividends. That's how you turn that slow trickle into a powerful current of compounding growth over time. You should choose growth stocks if you have a longer time horizon, at least 5 to 10 years minimum. This is your path if your main goal is maximum wealth accumulation, and you have the stomach to watch your portfolio value swing up and down without hitting the panic button. You have to be able to ride out the storm to get to the treasure. But here's the real pro move. You don't have to choose one. You combine them. Think of it like building a sports team. You don't just want power hitters. You need solid, reliable players too. The growth stocks are your home run hitters. They can win you the game in a big way. The dividend stocks are your consistent base hitters and strong defensive players. They keep you in the game, providing stability and steady points on the board. A younger investor might go 70% growth and 30% dividend stocks. Someone in their 40s might prefer a 60-40 or 50-50 split, starting to balance that aggressive growth with more stability. And you don't need to overcomplicate it. You can build a powerful, diversified portfolio with just a few low-cost ETFs. An S&P 500 fund like VOO or VTI gives you a great natural blend of both. If you want to tilt more towards income, you can add a dedicated dividend fund like SCHD. Want to lean harder into growth? Add a fund like VUG. It's that straightforward. So what's the final verdict? There is no single winner. There's only a better fit for your goal and your stage of life. The debate between dividend and growth stocks isn't about which is better in a vacuum. It's about which tool is right for the job you need to do. Are you building a source of income, or are you building a skyscraper of wealth? Answering that question is the first and most important step. Building real wealth isn't about chasing hype stocks or just collecting dividend checks. It's about patience, consistency, and having a plan that fits your life. Here's the bottom line. You don't need to own 100 different stocks. You just need the right ones for you right now.